If you are studying the subject of marine insurance, then this video is for you. This will make you familiar with the basic principles of marine insurance. I'll start with the concept of insurable interest. Under this principle, an assured can only recover under the policy if he has an insurable interest in the subject matter of the insurance. In other words, a contract of insurance is binding on the underwriter only if it is made to cover an interest which the law declares to be capable of being insured. This means that the assured usually holds or expects to acquire an interest in the nature of the property. It became necessary to establish this principle in order to prevent insurance from being used as a cloak for betting or wagering purposes. An insurance of the vessel, for instance, at a premium of X% for a voyage from London to New York is at first sight simply a bet of 100 to 1 that the vessel will safely reach New York. What distinguishes such a contract from a bet is that the assured must have an insurable interest or right of property in the ship. In the early days of maritime insurance, no such requirement was necessary. This gave rise to grave scandals and the law was accordingly altered. Insurable interest is the case notably wherein any legal or equitable relation to the adventure or to any insurable at risk in consequence of which he may benefit by the safety or due arrival of the insurable property or may be prejudiced by its loss or by damage to or by the detention of may incur liability in respect thereof. It might at first sight appear that a bet of 100 to 1 that the above vessel will safely reach New York involves a benefit or loss as she arrives or sinks, and that therefore there is an insurable interest. But in reality there is no interest other than that created by the wager itself. An interest to be capable of insurance must be won in the adventure itself. That is to say, the assured must stand to gain by the safe arrival of the vessel or lose because of its loss or destruction, quite apart from the bet itself. The most obvious case of an insurable interest is the ownership of the ship. It should be remembered that in the case of a shipping company, the latter owns the ship, not the shareholders. Even the owner of practically all the shares in the company does not thereby acquire an insurable interest in the company's vessels, for the company is a legal person apart from its shareholders. The latter may actually lose money if the company's ships are destroyed, for this may lead to reduced dividends or the liquidation of the company. Likewise, they may profit the vessel's safety, for their shares may yield more profit. But the law on marine insurance does not say you have an insurable interest wherever a person may benefit or lose by reason of the existence of the insured thing. The law, however, does provide a person must stand in a legal or equitable relationship to the property insured, and this direct relationship must cause him profit or loss according to whether or not the thing survives. Apart from owners, many other parties such as charterers may have a stake in the use and operation of ships. One of the most common relationships is that of the charter, and the question therefore arises whether charterers have an insurable interest in the ship they charter. In the case of demise charterers, it seems clear that the charterer has at least a possessor interest in the ship, which would give him the right to insure. Indeed, standard demise charter agreements can require charterers to keep the vessel insured to protect the interest of both owners and charterers. Under time and voyage charters, however, the charterer's interest in the hull extends only to the potential liability, which may arise if the ship is damaged through obeying the charterer's orders. While such liability is clearly not an interest in the way of property, the modern view is that it is sufficient to have a right in the thing insured or to have a right or be under a liability arising out of some contract relating to the thing insured. In many instances, it will be obvious that charterers will benefit from the preservation of the ship or suffer prejudice from its loss, and that they should be able to demonstrate an insurable interest makes good commercial sense. It is clear that a mortgager of the subject matter has an insurable interest and may insure up to the full value of the ship, but can only recover under the policy to the extent of the mortgage debt. If a ship is held in trust, the trustee alone is regarded as having a legal interest and as such may insure the full value of the property which is the subject of the trust. A person who has no insurable interest in the ship as such may nevertheless be able to insure the adventure on which she is engaged. Thus, a person might be interested financially in the undertaking of laying an Atlantic cable without having any interest in either the ship or the cable as such. A shareholder in a limited company has only a legal interest in his shares and not in the property which it owns. However, it has been held that where the company is engaged upon a business adventure, such as the laying of pipelines, the shareholders have an insurable interest in that adventure. Whatever may be the case of the shareholder, a creditor has no such interest even though he may know that the only chance of his loan being repaid is the successful completion of a certain voyage. Nevertheless, he will not be able to insure the adventure, for he has a legal claim against the debtor whether or not profits are made. While creditors in general cannot show an insurable interest, there is no doubt that a creditor who holds a lien on maritime property has an interest to the extent of his lien. The interest of the holder of a maritime lien will arise with the incident which brings the lien into being. For example, a collision or the completion of salvage services. However, the interest of a creditor seeking a statutory right of arrest cannot attach at the earliest when a writ is issued and possibly not until it is served. The question now arises, at what time must the assured have the interest in the subject matter of the insurance? The problem arises in this way. Suppose the owner of a ship insures her for 1 year and before the policy has expired he sells the ship. After the sale, the vessel is lost. In this case, the assured has an insurable interest at the time he effects the insurance but none at the time of the loss. This is not unjust. The law prohibits wagers and wager policies, and logically it might appear necessary to have the interest at the time when the insurance is affected, as is the case in other insurances. On the other hand, it may be very convenient to insure something in which as yet there is no interest. By doing so, no interval of time elapses between the acquisition of the interest and the taking out of the policy, and this may be useful from a business point of view. Two examples will make this clear. Where carriers wish to insure against their liability, as carriers they often take out policies, say for 1 year, as interest may appear. They may carry no goods when they effect the insurance, but the moment goods are loaded on board, their conveyance, the policy attaches, and they are protected from the very first moment. Any person may insure the whole of his interest. Thus, the owner may insure the whole value and the mortgager the value of the sum advanced. As insurance is designed to furnish compensation for losses automatically and independently of the solvency of any person liable, the existence of an action for damages does not prevent the person entitled to compensation from insuring. Thus, when a charterer undertook to indemnify the owner for any loss, the owner was nevertheless held entitled to insure. Likewise, a cargo owner may insure though he has a remedy cover against the ship owner. In such cases, the assured is of course not entitled to keep both the damages and the insurance money, because if he gets the damages, he has lost nothing, and if he gets the insurance money, he has suffered no damage. Closely connected with the concept of insurable interest is the principle of indemnity, under which the assured is entitled to be compensated precisely to the extent of the loss he has suffered as a result of the occurrence of an event against which the insurer has agreed to protect him. In other words, the assured is not permitted to make a profit on the insurance. From the doctrine of indemnity, two rules are derived. The first is that where the insurer settles for a total loss, the assured must abandon what is left of the thing insured to the underwriter. The other rule is expressed in the doctrine of subrogation. Under this doctrine, if the loss or damage is occasioned through the negligence or other unlawful act of a third party, so that the assured can claim damages, or if the assured has a contractual right to compensation, then the insurer is entitled to take over such rights on settling the loss. Insurers felt aggrieved by this state of the law. In their opinion, it gave a purely accidental and therefore unreasonable advantage or disadvantage, as the case might be, to insurers of ships belonging to the same owners, which comes into collision. To meet this difficulty, there is inserted in hull policies a sister ship clause, which provides that in the event of a collision between ships belonging to the same owners, the assured shall still have the same rights as he would if the property were not of his own. The principle of good faith is common to the entire law of contract, but the law of insurance requires an even higher standard. This is necessary because of the special circumstances prevailing in the maritime trade, which puts the insurer particularly or peculiarly at the mercy of the assured. Under the general law, no party to a contract must represent essential facts or must misrepresent essential facts to the other party. However innocent the misrepresentation, the other party can avoid the contract if the false statement was material and had induced him to contract. That is, if but for the misrepresentation, the other party could not have been reasonably expected to make the agreement. In general, only actual misrepresentations entitle the innocent party to rescind the contract. On the other hand, failure to disclose a material fact that is as a rule unobjectionable. For example, if you wish to enter into a service agreement and on inquiry wrongfully, though innocently, say that you are healthy, the prospective employer may avoid the contract. On the other hand, if you are not asked about your health and do not disclose that you are a carrier of germs, the employer has no right of rescission, however material this fact may have been in his decision whether to employ you. The general rule may be sufficient for ordinary contracts, but it is certainly unsatisfactory in certain cases where one party is peculiarly defenseless in case of the non-disclosure of material matters. This rule has therefore been tightened, for instance in the law relating to limited companies, and it has always been more stringent in the law of insurance. Insurance would obviously be impossible as a genuine business unless the insurer could rely upon having knowledge of all the matters known to the prospective assured and which enable him to calculate carefully the probable incidence of the risk. A person who is about to effect a policy must therefore not only make no active misrepresentations but must also disclose to the insurer every material circumstance, that is, everything which would influence the judgment of a prudent insurer in fixing the premium or determining whether he will take the risk. Disclosure must be made before the contract is made. As I have already explained, marine insurance business is transacted in a somewhat informal manner and it may be some time before the policy is issued. For this reason, the moment at which the contract is actually concluded has been the subject of some debate. It has therefore been provided that the contract is deemed to have been concluded when the insurer has accepted the proposal, and this is commonly proved by the slip bearing the insurer's initials. Of course, in the ordinary way, a person can only be expected to disclose facts which he knows, but insurance business would be even riskier than it is if the prospective assured were allowed to take shelter behind his bad memory or ignorance. In the eye of the law, a prospective assured is deemed to have knowledge of every circumstance which in the ordinary course of business ought to be known by him. Where an agent, example a Lloyd's broker, negotiates the policy, he must disclose to the insurer every material circumstance that he should know in the ordinary course of his business and all that ought to have been communicated to him by his principal. However, if the assured hears of a material fact when it is too late to be communicated to the agent before the risk is accepted, then failure to disclose will not entitle the insurer to avoid the policy. It should be noted that what in old cases is called concealment need not necessarily mean that some material fact was deliberately or fraudulently suppressed. Concealment there means simply what now is termed as non-disclosure. In the modern law, fraudulent concealment gives of course also a right to avoid the policy. Besides, the insurer may bring an action for deceit. While the law thus imposes a heavy burden on the assured, this rule should not be unduly extended.